teach the investor how to
Hmm.
fish. Give them enough wherewithal and enough acumen and enough financial literacy so they have the ability to make some of these decisions themselves.
Today, I had a great conversation with Bill Kelly, the CEO of CAIA, the Chartered Alternative Investment Analyst Association. This designation is the premier charter for alternative investments with over 13,000 members worldwide. Since Bill took the helm, he's been actively working to build up the alternatives industry. He seems to be everywhere, from speaking at conferences, to meeting with members, to engaging key influencers. Now, Bill has a tremendous resume. He spent the past 42 years in progressive managerial and boardroom roles. As he likes to say, he has bottom-up experience working in all aspects of financial companies, moving through successive CFO, COO, CEO, and of course, board director roles. Even with all his accolades and the demands on his time, he's incredibly gracious and remarkably approachable. His enthusiasm and depth of knowledge are palpable. This was a lot of fun. Welcome to my conversation with Bill Kelly.
And you might know, I forget when you first reached out, Matt, but CAIA did announce my retirement just
Yes.
last week, so it doesn't mean I'm leaving the stage. I'll be on it in a different capacity, but just so you're aware of that as well. I didn't want that to surprise you if you didn't know about it already.
Oh, no surprises at all. In fact, I'm excited for you because you've had a great career so far. But I'm interested to hear what's next for you too. Do you have any plans of what you hope to accomplish or hope to do? I guess
Yes.
when you're retired.
Yeah, so I did start my own podcast with Kaya called Educational Alpha about a year and a half ago. I'm going to look to continue that. I'll probably still contribute content to Kaya, but in a non-operational way. I'm a director on a couple of boards, one a mutual fund board, and secondly a non-depository trust company. And I'm involved in a credential for the director space in the UCITS. It's the Institute of Banking out of Dublin has got a credential to try to bring professionalism to the director space. So hopefully I'll spend more time with that as well. So I've got a pretty good portfolio of stuff that I've started, and I'd like to add maybe one or two more things to it.
And now it can just be for fun, right?
Yeah,
Just
yeah,
get to enjoy it.
yeah. And I've got five kids, and most of them are out of state now, so no grandkids yet, but maybe spending a little bit more family time too. So maybe a little bit more balance, but still looking to be engaged.
Bill, I do want to reiterate, it was great to meet you. When we met at the, I guess it was Alts TX,
Yep.
back in December or November of this past year. And I was just so struck by you and how personable you were and how accessible you were to all of us in the industry there. And really appreciated your comments too. But I do want to know a little bit more in depth about you and where you're coming from and why you're committing so much of your career to the alternatives industry. You're ending here in CAIA, and it sounds like you spent about half your career, half of your 40 years in the alternative space. So why is it? What is it about it that captivates you?
Well, I think it's been an evolution as opposed to a revolution, like most things in life. And I got out of college in 1982, so 42 plus years ago, and spent financial services, but started out with Price Waterhouse. Spent a little bit of time at Bear Stearns well before they went under. But when I moved to Boston in the late 1980s, that's when I really committed myself to the field of asset management, and I was on the buy side with a couple of good-sized firms initially, the Boston Company, which was part of Shearson, Lehman, American Express, and I was with their institutional arm, which was primarily long-only equities. But we were early on starting some single strategy hedge funds, long short equity. We probably launched these products 90s, mid 90s, which I think even in the hedge fund space was kind of just warming up, and it certainly was not
Mm-hmm.
anywhere near the 5 trillion it is today. It was probably maybe even
Right.
less than $1 trillion. So we're always thinking about extracting value wherever it could be found. And while we were mostly focused on long only side, then we had some of these long short offerings. But after we sold Boston Partners, I was one of the founders, sold it to Robeco. That was probably the beginning of my entree into alternatives. Robeco in Rotterdam had previously bought Weiss Peck and Greer, which is an old line firm out of New York, and they were very early in the venture private equity space and also single strategy hedge funds. And to show how early they were, one of their first venture investments was a tiny little company called FedEx. And Phil Greer of Weiss Greer, I'm not sure if he's still alive or not, but he was on the compensation committee on the board for many, many years. So it was interesting to get that window in, even though we were not directly involved. It was part of the offering of the U.S. product lineup.
Hmm.
And when I left, and this is sort of maybe the stepstones toward alternatives, I joined the board of a firm called Salient Partners, and they had a product called the Endowment Fund, and this product was sold into the big wirehouses, and the sort of the pitch was you can invest like David Swensen at Yale and do it for as little as I think 50 or $100,000. And it worked until
Hmm.
it didn't work anymore. And I think the difference between David Swensen and the average, more retail oriented investor is long termism. And Swensen goes into a deal, and the longer that money stays in the ground, compounding at an attractive return rate, the happier he is. Where the more retail oriented investor wants out when they want out. And I think we're
Hmm.
seeing this movie playing out again in the current market today. I don't think we've created the killer app. I think the interval fund seems to be the right solution. But I think if the investor wants access to illiquid holdings like private equity, like infrastructure, like real estate, like private debt, we should not have leaky valves where they can get quarterly liquidity. So fast forward to CAIA, where I've been the last decade, we're trying to bring professionalism. We're trying to bring transparency. We're trying to bring discussions between the asset owner and the asset manager and talk about responsibilities on both sides. And I think we have a responsibility to give the end investor and the more retail oriented investor access to the private markets where value creation is now happening today, full stop. There's no such thing really as an active small cap market in the public market space. That's all moved private. But how do we do that? How do we do that responsibly? How do we have a
Hmm.
conversation about how important it is to have a long-term hold? And if the investor wants liquidity, they should just access the public market beta and not be thinking about the private market. So a lot of work to be done there. We can talk about the retirement promise, which I think is largely broken or has to be rethought, which is the theme of Fink's most recent letter. But maybe I'll take a pause there. I think the job is not done yet. We still have a lot of wood to chop, but maybe to finish with this, Matt, that if you and I assume you're going to manage your own retirement as I am through a 401k plan, if the home of lending is no longer the banks and syndicated loans, it's all gone private,
Hmm.
and the home of capital formation in the equity space is all gone private, how can we build a comfortable retirement with just the public equity offerings and public fixed income and public equity? It's just not the right solution. So how we square that circle is, if we can solve for that in the next half hour, we deserve a Nobel Prize.
Absolutely, absolutely. So you've done it. You've done a lot in your time at CAIA. It's been 10 years. You've seen a lot. You've had a lot of great conversations. What kind of transitions have you seen in the industry over that time frame to where we are today, and even looking beyond that? I'd love to hear what you see in the next year or two in the more immediate future.
So when we started, I was not there, but the people ahead of me started Kaya in 2002 timeframe. Uh, Really, the alternatives are really the hallmark was the tradable strategies. So you think about CTAs and the hedge fund space. That's really what was all the action. And the private markets were there, but they were just kind of warming up, and private debt didn't really even exist back then, and now that's a $2
Hmm.
trillion asset class on its way to four, if you believe what Preqin writes, and there's no reason to take the other side of that. So we saw that evolution probably more toward the private markets coming out of the GFC, and that's really when the private debt market began because the banks was just too expensive for them to lend. And when you had very inexpensive ways of leveraging your private equity investments, the private equity market really took off then too.
Sure.
So certainly the tradable strategies and hedging and hopefully yielding better risk-adjusted returns over time very much has a place in a portfolio, but the attention span and the focus has moved much more to private. So I think we've seen an evolution where a lot of our early members and candidates taking our exams may have been coming from the CTA or the hedge fund space, and we're still seeing that. We're starting to see more and more people from the GPs and the asset managers with private products showing up at our doorstep as well. And I think that's a terrific development because it's showing that a lot of these large companies believe in professionalism. They believe in understanding
Yes.
how to bring solutions forward to the client. And ultimately, what we're trying to accomplish is it's not so much what you have on your shelf to sell to the client. It's much more important how does that product fit into what they're trying to accomplish in the whole of their portfolio. And I think if you can put yourself in the shoes of an allocator and think like an allocator, think like that end client, your solution may not fit into that portfolio today. And you should not be
Hmm.
afraid to say that because if you can build a relationship centered around trust, it's going to lead to better outcomes. But if I look at CAIA, maybe just to give you some hard stats or harder stats. So when I joined,
Please
yeah, when I
bring the numbers.
yeah, when I joined about 11 years ago, we had probably 6,500 members around the world in about 80 countries. We're in over 100 countries now. We're probably at about the 14,000 level. Coming out of COVID, the candidate numbers came down a little bit because who's going to study for a high stakes exam? If they could get COVID or the exam window, the seating is going to be closed. But those numbers will come back very, very strong. It's looking like this cycle we're now involved in, which is for the September cycle of this year, it could be our strongest cycle in the history of CAIA. We're seeing more and more private market entrants coming into the pool, as I said a moment ago. So I think that as we get into this democratization trend more deeply, I think the importance of professionalism, what that does to a brand in terms of enhancing it, more and more, I think CAIA's role in our very best days are ahead of us. So I'm leaving the stage at an interesting time. I've always felt that the title of CEO or the mantle of CAIA was never something I owned. It belongs to ultimately the investor community that we serve. And like so many things in life, I try to leave it in slightly better condition than it was when I inherited it. History will tell whether or not I was able to do that, but it's been a very interesting run for me the last decade plus, and I'll still have certainly a hand in the game and some roles as I think about the next act for me as well.
Yeah, you bet. That now you mentioned democratization. That's something that I'm fascinated by, especially in the alts world because it's incredibly complex. But I know that you have a strong emphasis on education. So talk to me a little bit about where you see the democratization piece, education, and then even where regulation fits into all of that in your eyes, being in the middle of all this.
Yeah, so there's a lot of moving parts, and it's like an orchestra. They all have to be playing in concert, as opposed to if I have a very good violinist, but they're doing their thing off key or off timing. Maestro's not going to be very happy, and I think what we probably lack is that maestro. And maybe Kaya's trying to play that
Hmm.
role where we're saying uh, the GPs have a role, the investors have a role, regulation has a role, the media has a role. And I think the media clearly cannot be talking about all of the disadvantages, and there are some, but there are also opportunities as well, and we've got to be responsible enough to talk about both sides of that coin. Legislation, same thing too. I think there's just been a lot of accusations and misdirection about what alternatives are, and there's a lot of rhetoric that defines professionals and maybe paints them in an unfavorable light, sometimes deserved, oftentimes not as well. So we've got to figure out how to bring all of this together under maybe the heading of why does democratization make sense in the first place? And as we talked about a moment ago, if you and I have responsibility for our own retirement, why should we only have access to two asset classes? And if I look at my
Hmm.
parents' generation, my dad in particular, he worked for the same company the entirety of his career. He had a defined benefit plan indexed to inflation, so he didn't have to worry about longevity risk. And I think that's a big issue for people today that if I retire at 65, 70, or even 80 years old, I could still live for another 2 decades. Do I have enough money?
Hmm.
Are there outcome oriented products that somebody's been able to talk to me about? Is it done in a tax advantaged way? I don't think we're having a lot of these conversations. And if we're going to just allow a loosening up of regulation so you and I can have access to infrastructure or real estate and not really understand how that fits into my portfolio, not understand the concept of long-termism, not even understanding what are my after-tax returns and what's the efficiency of this product. So it's not just after fees, it's after fees and after taxes. And does this make sense to me? So there's a lot of things that still need to be explained and understood. And maybe just to finish, Matt, with regulation as
Hmm.
well, I think it's very, very hard to be a regulator in today's
Yes,
environment.
I agree. I
And
can't imagine being in that seat.
no, and I think
Yeah.
Gensler has gotten a lot of criticism with the SEC, maybe some
Hmm.
of it deserved, but I just wrote a letter to the editor of Barron's last weekend. There was an expose on Gensler and
Hmm.
talking about how he may be out of his job if there's a different administration, and even if the same administration stays, maybe his 5-year term is up, and he's trying to get a lot of things done. But I'm saying it's less about Gensler. It's more about the investor. And to think that we should
Yes.
not have more regulation, given all the change that's going on, it's certainly we need more. But then I think the difficulty for Gensler or any regulator around the world is that, how do we protect the investor? In the good old-fashioned days and ways, it was more regulation. But if we
Hmm.
bring more regulation and greater efficiency to some of these markets, the alpha component is going to be rinsed out completely. If we could create an investable index in the private markets, it could be a home run for the end investor. I don't know how we
Oh,
do
it's a
that.
game changer.
It would
Yeah.
be an absolute game changer. So we need a
Yeah.
vanguard to go in there and figure that out. But in the meantime, it would be great if part of regulation and the regulator's mandate is to teach the investor how to fish, give them enough wherewithal and enough acumen and enough financial literacy so they have the ability to make some of these decisions themselves. And that is a very,
Hmm.
very difficult thing to do. The average investor may not care about it. They may not have the vocabulary and literacy to understand it if somebody took the time to explain it to them in the first place. And if that's the answer, then do we need to have some advice intermediary that's accessible that can call the balls and strikes? We don't even have rating agencies involved in the portfolio companies that are in the private equity portfolio, or even all of this direct lending that's taking place. So, how's the
Yeah. Well, there's
investor?
just incredible complexity with that right now too.
It is. And then how's the average investor going to fare with all of this? So we do have to give
Hmm.
them access because we gave them the responsibility to fund their own retirement. But there's a
Hmm.
lot of minefields and mines planted between the investor and access to that end product. And getting them there safely is a tremendous responsibility that we all have in this ecosystem.
Yeah, absolutely. Now, what would you recommend to an investor if you're taking the seat from working with the industry insiders or the industry folks, and you're looking at the investors? What advice would you give to an investor who's venturing into this space?
Well, I would say unless you've got the knowledge yourself or an advisor who you trust and you trust their due diligence and you trust their ability to get access to the right investments, I would say think about long term, think about 60/40, think about getting your diversification by maybe trying to access some of the smaller names that are still in the public space. Think about maybe non US investing and leave it at that. And you say, well, that sounds crazy. Well, if you look at the public versus the private equity market, the median returns are pretty much undifferentiated. The correlation is zero point 0.9. So 90% of the time, if I just go and find a private equity manager, after fees and after taxes, I'm going to probably get something undifferentiated. I can fall in love with the yield in the direct lending private credit space, but do I really understand the risks involved in that underlying company? Am I being compensated for those risks? And unless I can figure out those for myself through an advisor, am I better off just going and getting a risk-free rate at 4.5%? Now, with
Hmm.
inflation sustaining something north of two, it's still not hugely attractive, but at least you've got some upside. So I think that herein lies the problem. How do we give the investor the access and the wherewithal?
Yes.
One of the things I think Fink alluded to this in his letter on rethinking retirement, and I'm not saying that he stole my idea. I doubt he reads anything I write, but I've been talking about this a lot. Where I think in a perfect world we should try to replicate what the super funds in Australia do. So if I, instead of clipping my 6 or 8 or 12% every 2 weeks out of my paycheck and dropping it into really very uninteresting collection of 40 Act mutual funds, if I could turn that over to an institutional investor and they were gathering my 6% and everybody else 6%, and this fund was, say, billions of dollars, and they were doing the due diligence on my behalf, and the risk
Mm-hmm.
is on me still, but they're doing the manager selection, they're doing the due diligence, they're figuring out who's the best infrastructure manager, who's the best real estate manager. So I've outsourced the responsibility to a massive commingled fund, and they have the buying power too. So they're the ones that can go back to the big PE shops and the infrastructure shops and say, I ain't paying you 2 and 20. But me as an individual, if
Mm-hmm.
I'm going to get access to an interval fund, I'm
That's
probably
right.
paying 2 and 20. I'm getting a bad tax answer, and the rest is, we know how that story will end. So I really do
Sure.
think that we can't just say, well, here's what we have and how are we going to fit these products in. I think we have to go from the top down and figure out, is there a way of rethinking the whole retirement system?
Yeah, I completely agree with you there, and I think there's a lot of opportunity ahead of us. But we've talked a lot about the risk. I would love to hear your thoughts about what are the opportunities. You've mentioned a few options, but are there further opportunities that you're seeing within the industry itself, and as far as getting access to alts, or even I don't know, maybe making it. I don't know. What do you see as the opportunities moving forward?
So I think that there's a couple of collisions happening here. One is this, the retirement promise and democratization,
Yes.
and we have not talked about tokenization and fractional shares of virtually anything that's out there. And there's been a couple of interesting models. iCapital is a very good friend of Kaya's. They're a sponsor of my
Mm-hmm.
podcast, and I think you have these fintech providers that can stand in between a very traditional GP setup where they're really geared only to having maybe a half dozen or so shareholders in their fund. I
Mm-hmm.
don't think they're ready to have thousands and thousands of them. But I think a model like iCapital can help solve for that. Spot Bitcoin was launched as an acceptable regulated offering by the SEC under the threat of this grayscale litigation just a month or so ago, maybe 2 months ago. And I don't know if I find that so interesting, and I'm not going to go down a Bitcoin rabbit hole here, Matt, unless you want to. I certainly have views there, but I
I
think
do have a follow up question on that, but
okay,
not specifically.
but I
Yeah.
think the bigger story there though is the distributed ledger. Nobody likes to talk about the plumbing in the basement,
Yes.
but when it fails, you're talking about the plumbing in the basement. It is the infrastructure that gets stuff done. And if I think about your question now, where maybe part of the solution, if we can't create the super fund setup, part of the solution could be maybe we could take some of these private offerings and put them on the blockchain. And Hamilton Lane and I think KKR have already tested this. I don't know how it's worked out, but some of their recent offerings, they had the traditional uh, master fund set up in a tax neutral jurisdiction. I think in both cases, the Cayman Islands. But then there are feeder funds that hang off it. I think both Hamilton Lane and KKR had a feeder fund on the blockchain. And here, I think, as the story goes, that if you need to raise liquidity, the fund doesn't have to sell anything. But if you want in and I want out, somebody's going to have to referee that. We're going to have a price. If we both like the price, transaction happens. If we don't, it doesn't. So maybe it's a way of providing some form of liquidity in less liquid markets. And as a general thought, I like that mousetrap a lot better than an interval fund. And the problem with an interval
Interesting.
fund is that you talk about what happened with B Read, and now Starwood seems to be having some problems in their property fund with redemptions as well. And we talk about the poor shareholders that can't get out because the fund has potentially gated. I think about
Mm-hmm.
the poor shareholder that's in and understood the product in the first place, and they're in it for the long term. Now all of a sudden, the fund is having to create liquidity because there's no subscriptions. Existing shareholders went out because somebody maybe yelled fire or they smelled smoke and they're jumping out at the inopportune times, and the fund is now having to raise liquidity to get them out. But as me, as a long-term shareholder, that's a horrible outcome. But if they could
Yeah.
transact with somebody on a blockchain and it's not affecting cash flow or raising of cash in the corpus itself, I think that's awesome. So I think we're on the early stages of what's going to happen here. And I also think ultimately, Matt, that today and tomorrow's stock certificate is some kind of a non-fungible token or
Yeah.
electronic piece of paper. And we're technically electronic anyway. And we're now, I don't know when this is going to be recorded, but in a handful of days, the public equity markets are moving toward T plus one. It still takes a full
Hmm.
day to settle 100 shares of Apple computer. I could get a pizza delivered from Los Angeles and to my front door in probably 7 hours. So it's
Yeah.
insane. It's insane. So I think that because of regulation and TradFi to DeFi, things move kind of slowly. But I
Yeah.
think that this will be part of the solution, the whole fintech.
No, it's funny. You answered my question. My follow up, it just in your answer there, because I think the blockchain, regardless of what people think of crypto, as far as being a currency or a value hold, the blockchain technology in and of itself holds a very unique property for investment securities vehicles. And I think you illustrated that very, very well there too.
Yeah, and I don't think I did this on a panel, Matt, recently. Somebody asked me the question, but the origins of the New York Stock Exchange go back 232 years ago, the Buttonwood Agreement. And there was 2 dozen specialists that said we're going to fix commissions, we're only going to trade amongst ourselves. Sounds a little bit like collusion before the SEC existed, but off we went. So it took of the 232 years from now back to then, it took about 225 for the first public stock to have $1 trillion market cap. It was Apple in 2018. So it took 225 years for
Yes.
that to happen. Bitcoin was launched with Satoshi, I don't know, 2008, 2009. So
Right.
about
Right.
15 years later, it's $1 trillion asset class. How could that possibly have happened? A lot of reasons why. It could not have happened if it wasn't on the blockchain, trading
That's right.
24/7. But now, as I said, we're T plus one in the private markets, and Bitcoin is trading 24/7 and it's reached $1 trillion already. So I
Hmm.
think that it just shows the power of that technology, especially if it's done on some form of distributed ledger, which is immutable. And I think that I find very, very interesting, and I think a huge opportunity and a game changer ultimately for our industry.
Interesting. Well, that's a perfect way to end, I suppose, because you just kind of ushered us into the new era of whatever that becomes. There's certainly a way to usher it in right now. But Bill, thank you so much for this time. Thank you for all that you've done for CAIA, for our industry. And we're looking forward to seeing what you do, not just for the rest of this year, but for the many years to come as you continue to influence all of us. And thank you again for your time today and joining us at the podcast.
Pleasure. Thank you, Matt.